Hello, Assalamualaikum, and I wish you a very good day ahead. So today, my group members and I will be presenting about chapter 23, which is the audit of cash balances. So the first presenter will be me myself, Afaf Alia binti Muhammad Azmi, followed by Nur Nabiha binti Ismail, Muhammad Haziq bin Muhammad Tuah, Nur Nabila Natasha binti Zul Husni, Muhammad Fikri bin Abdul Ghaffar, Nur Shahira binti Ahmad, and lastly, Nur Syafiqah Auni binti Muhammad Al-Hakim. In this chapter, there will be 6 learning objectives that will be explained later by my group members, and those learning objectives are shown in the slide. So, let us begin with the first learning objective, which by the end of my presentation regarding the learning objective, you will be able to show the relationship of cash in the bank to the various transaction cycles. It is easy to see why the general cash account is seen as crucial in practically all audits, even when the final value is insignificant and immaterial. The amount of cash going into and out of the cash account is frequently more than the amount of cash flowing into and out of any other account in the financial statements. So, as you can see in this diagram, it shows how these 4 cycles are related to one another. All 4 transaction cycles, capital acquisition and repayment cycle, acquisition and payment cycle, sales and collection cycles, and lastly, payroll and personnel cycles are all related to the cash in bank account. So let us take a look at sales collection cycle as an example for a clearer vision. The cash receipts and cash deals are often involved the cash transaction in which needed to be recorded in the cash in the bank account. So now that we know the relationship of the cash in bank to the various transaction cycles, we shall discuss examples of misstatements that may not be discovered as a part of the audit of the bank reconciliation, as the misstatements can be discovered during the audit of the cash transaction. So, misstatements such as failure to bill a customer, for example, during the managing phase of cash flowing in and out will result in misstatement of the audit of sales and collection cycle. Also, when an embezzlement of cash received from the customers, for example, there are some mistakes on the credit adjustments in which they fail to record and document the credit transaction will lead to misstatements on the cash on the bank account. Next, example of misstatements that are usually found in the acquisition and payment cycle. So duplicate payments will lead to overpayment of invoice, so the expenses will be overstated. Improper payment of personal expenses, for example, the employee made a mistake when they want to compute the payment will also lead to misstatements. Lastly, if the payment of raw material is not received, then there should not be a record for the payments in the cash in bank account, as this will also lead to misstatements. Another simple example for a misstatement that can be discovered in the transaction cycle, which is in the payroll and personnel payment cycle, is when the payment to the employee for hours not worked is being recorded when the payment should be less and only get paid for working hours. Last of all, the misstatement that can be discovered during the capital acquisition and repayment cycle. So, for example, the payment of excessive interest to the related party will cause credit charge to the cash in the bank account. Hence, it proves how every transaction cycle is related to the cash in the bank account. We have discussed the misstatements that cannot be discovered in the task of bank reconciliation. We shall now discuss the example of misstatements that actually can be detected during the task of bank reconciliation. Firstly, failure to include a check on the outstanding checklist. This means that the check that has not been cleared even though it has been recorded in the cash disbursement journal. Next is cash received by the client is recorded in the wrong period. For example, the check received subsequent to the balance sheet date but is recorded in the current date. Next example is deposits recorded near year-end deposited in the bank in the same month and included in the bank reconciliation as a deposit in transit, which makes it looks like the deposit is not yet received when it is actually deposited on the same month. Lastly, payments on notes payable debited directly to the bank balance but not entered in the client's record, in which is obviously should be recorded properly on the client's record to avoid any double accounting. So, that is all from me. I shall pass the presentation to our next presenter, Nur Nabiha.
Thanks to Afaf Alia, my name is Nur Nabiha binti Ismail, and I will explain about learning objective 2, which is to identify the major types of cash account maintained by business entities. So there are 5 types of cash accounts, which is the general cash account, impress payroll accounts, branch bank account, impress petty cash fund, and cash equivalents. What are these 5 accounts? So I will explain about it one by one. For the first one is general cash account. For most companies, this is their main bank account. Almost all cash receipts and disbursement flow through this account at one point or to another. It is used to record cash collected from such activities such as cash sales and account receivable, as well as to make payments for expenses and capital assets. This is a type of account that is typically used by small business with only one account. The second one is impress payroll account. The exact amount of the payroll for the pay period is transferred from the general cash account to this bank account. The account can be maintained with a fixed balance. It is used to pay employees and helps in improving internal cash control and reducing the time taken to reconcile bank accounts. Next, the third one is branch bank account. A branch of a company maintains a separate account with a local bank. It is possible to have a general account or an impress account. The usage is controlled by what the head office has authorized. At the local level, it allows for quick deposits and payments. It also strengthens business relationships with local banks. The fourth is impress petty cash fund, a cash reserve or fund of cash that is maintained by the company for small cash payments. The fixed balance is quite small and is reimbursed on a regular basis. A petty cash account is as simple as putting away a set amount of money in a cash box for unexpected expenses. It is used for small payments that are quicker and easier to do by cash rather with a check, such as paying for office supplies. The last one is cash equivalents. It refers to short-term, highly liquid investment with a known value and a low risk of change, such as time deposits. When bank overdrafts are being used regularly, such as when a bank balance fluctuates, the bank overdrafts are also considered a cash equivalents despite the fact that they are a liability rather than an asset. In a simple word, excess cash is frequently invested in short-term, highly liquid cash equivalents. It was also used to manage fluctuating cash levels in order to ensure that cash was accessible for short-term needs. Time deposit, certificate of deposit, and money market fund are examples of this. From this figure, it shows that the relationship of general cash to other cash accounts that all cash either originate from or is deposited in the general cash account. The general cash account is like a home to others' cash account. All cash account will deposit to the general cash account and credited to other cash account. For example, branch bank account will deposit their money into general cash account before credited to the impress payroll account. And the other example is cash equivalent will deposit the money into general cash account and the general cash will credit the money into impress petty cash or impress payroll account. So, for a reminder of this chapter, the focus is on auditing the three types of the general of the account, which is the general cash account, the impress payroll account, and the impress petty cash account. That's all from me. Thank you. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Haziq and I will explain the learning outcome 3 for chapter 23. So the methodology for designing tests of balances for cash in the bank is separated into 3 phases. In phase 1, we identify client business risks affecting cash in bank, and second is set tolerable misstatement and assess inherent risk, and third is assessing control risk. And in phase 2, we design and perform tests of controls and substantive tests of transactions for several cycles. And phase 3, we design and perform analytical procedures for cash in bank, design tests of details of cash in bank to satisfy balance related audit objectives. So now we look at phase 1. So the first thing we do in phase 1 is we identify client business risks affecting cash in banks. So these business risks may arise from inappropriate cash management policies or handling of funds held in trust for others. So these risks are more likely to arise from cash equivalents. So the auditor should understand the risk from clients' investment policies and strategies as well as management controls. So the second thing in phase 1 is to set tolerable misstatement and assess inherent risk. Cash balance is not material, but cash transactions affecting balance are almost always extremely material. Cash in comparison to other assets is more susceptible to theft. So there is high inherent risk for existence, completeness, and accuracy objectives. So now we move on to assessing control risk. So there are two categories in control risk. The first one is controls over transaction cycles, affecting the recording of cash receipts and disbursement. And the second one is independent bank reconciliations. So the first one, controls over transaction cycles affecting the recording of cash receipts and disbursement. If controls affecting cash-related transactions are operating effectively, control risk is reduced as the audit test for the year-end bank reconciliations. Some of the examples of the controls over transaction cycles are adequate segregation of duties between check and signing and accounts payable functions, signing of checks only by an authorized person, and pre-numbered checks printed on special paper. We move on to independent bank reconciliations. This is the second category. So independent bank reconciliation is done monthly on general bank account on timely basis by someone independent of the handling or recording of cash receipts and disbursements as essential control. This bank reconciliation is to ensure that the accounting records reflect the same cash balance as the actual amount of cash in the bank after considering reconciliations items. So the control is enhanced when a qualified employee reviews the monthly bank reconciliation soon after its completion. So the actions taken to do these independent bank reconciliations are as follows. First, we compare cancelled checks or electronic bank records of payment with cash disbursement records for date, payee, and amount. Second, we examine cancelled checks or electronic bank records of payments for signature, endorsement, and cancellation. And third, we compare deposits in the bank with recorded cash receipts for date, customer, and amount. And fourth, we account for numerical sequence of checks and investigate missing ones. And fifth, we reconcile all items causing difference between book and balance and verify appropriateness for the client's business. And sixth, we reconcile total debits on the bank statement with the totals in the cash disbursement records. And seventh, we reconcile total credits on the bank statement with the totals in the cash receipts record. And next, we review month and interbank transfer for appropriateness and proper recording. And lastly, we follow up on outstanding checks and stop payment notice. So this independent bank reconciliation should be done monthly. So we move on to phase 2. So phase 2, the first thing is to design and perform tests of controls and substantive tests of transactions for several cycles. In many audit, the year-end bank reconciliation is extensively audited using analytical procedures to test the reasonableness of the cash balance is therefore less important than it is for most other audit areas. The starting point for the verification of the balance in the general bank account is to obtain a bank reconciliation from the client for inclusion in the audit documentation. So that is the only thing in phase 2. So in phase 3, we design and perform analytical procedures for cash in bank. So auditors compare the ending balance on the bank reconciliation, deposits in transit, outstanding checks, and other reconciling items with the prior year. Auditors also compare the ending balance in cash with previous month's balances. These analytical procedures may uncover misstatements in cash. Next. So next in phase 3, we design tests of details of cash in bank to satisfy balance-related audit objectives. So the first step is to obtain a bank reconciliation from the client. So this is to ensure that the client has made adjustments if there are material misstatements. Second is verify whether the bank reconciliation received is correct. Most important objectives are existence, completeness, and accuracy. And lastly is performs tests related to the 4 presentations and disclosure objective. This can be done by reviewing of minutes and loan agreements to determine if there are restrictions on cash that must be disclosed.
My name is Nabila Natasha binti Zulhusni. Now we will move to the balance related audit objective. Okay, as you can see in this slide, there are 5 audit objectives, which is detail tie-in, existence, completeness, accuracy, and cut-off. Now we will move to the first audit objective, which is detail tie-in. Detail tie-in is a cash in the bank as stated on the reconciliation foots correctly and agree with the general ledger. So their common test of detail of balance procedure is trace the book balance on the reconciliation to the general ledger. Now we will move to the existence. Existence is cash in the bank as stated on the reconciliation exists. So the common test of detail of balance procedure is receipt and test of a bank confirmation, receipt and test of a cut-off bank statement, and others. Next is a completeness. Completeness is existing cash in the bank is recorded. So the common test of detail of balance procedure is test of the bank reconciliation, extended test of the bank reconciliation, and others. Next, we will move to the accuracy. Accuracy is cash in the bank as stated on the reconciliation is accurate. So, the common test of detail of balance procedure is same as existence and completeness because of their close interdependency. Lastly is a cut-off. Cut-off is a cash receipt and cash disbursement transaction are recorded in the proper period. So, the common test of detail of balance procedure for the cash receipt is trace deposit in transit to subsequent period bank statement. And cash disbursement is trace outstanding checks to subsequent period bank statement. Okay, in this slide, I will show you the example of audit schedule for a bank reconciliation. Okay, as we can see in this schedule, we can see that they also have a prepaid by and approved by, and they also have a day. Okay, now we will move to the next slide, which is 3 procedure merit additional discussion because of their importance and complexity, which is receipt of a bank confirmation, receipt of a cut of bank statement, and test of the bank reconciliation. Okay, now we will look receipt of a bank confirmation. For your information, bank confirmation are not required under auditing standard, but the auditor usually obtain a direct receipt of a confirmation from every bank or other financial institution with which the client do business, except when there is an unusual large number of inactive accounts. But if the bank does not respond to a confirmation request, the auditor should send a second request or ask the client to communicate with the bank to ask it to complete and return the confirmation to the auditor. The second procedure is a cut-off bank statement. Okay, cut-off bank statement is a partial period bank statement and the related copies of or digital access to cancel check, duplicate deposit slip, and other document included in the bank statement provided by the bank directly to the CPA firm office or through online access to the bank electronic record of the client's bank account information. Okay, the purpose of cut-off bank statement is to verify the reconciling item on the client's year-end bank reconciliation with evidence that is maintained by the bank, not the client. So, the auditor will perform the following verification in the month subsequent to the balance sheet date, which is put the list of all cancelled check, debit memo, deposit and credit memo. They also will verify that the bank statement balance when the footed total are used and review the item included in the footing to make sure that they were cancelled by the bank in the proper period and do not include any erasures or alteration. The last procedure is a test of bank reconciliation. A well-prepared independent bank reconciliation is an essential internal control over cash. Auditor tests the bank reconciliation to determine whether the client personnel have carefully prepared the bank reconciliation and to verify whether the client's recorded bank balance is the same amount as the actual cash in the bank except for deposit in transit, outstanding checks, and other reconciling items. The auditor's verification of the reconciliation involves several procedures. First, verify that the client bank reconciliation is mathematically accurate. Second is trace the balance on the bank confirmation and or the beginning balance shown in the online client banking record or in the cut-off statement to the balance per bank on the bank reconciliation to ensure they are the same. Third is trace checks written and recorded before year end and included with the cut-off bank statement to the list of outstanding checks on the bank reconciliation and to the cash disbursement journal in the period to the balance sheet date. Fourth is investigate all significant checks included on the outstanding checklist that have not cleared the bank on the cut-off statement. 5 is trace deposit in transit to the cut-off bank statement. Last but not least is account for other reconciling item on the bank statement and bank reconciliation. Okay, in this slide, we will show you about the type of audit test used for general cash in the bank. Okay, this is a ledger of cash in bank. So in the debit part, we have the beginning balance cash receipt and ending balance. While in the credit part, we have cash disbursement. So in the debit part, the beginning balance cash receipt will be audited by the test of control, substantive theft of transaction, and analytical procedure. The ending balance will be audited by the test of control, analytical procedure, and test of detailed balance, while the cash disbursement will be audited by the test of control, substantive test of transaction, and analytical procedure. Okay, I think that's all from my part.
Assalamualaikum and hi. Thank you to the previous presenter. My name is Muhammad Fikri bin Abdul Ghaffar. I will present about learning objective 4, which is the objective was recognize when to extend audit test of the general cash account to test further for material fraud. In this learning objective, I will explain about fraud-oriented procedure. A major consideration in audit of the general cash balance is the possibility of fraud. The first point was the auditor must extend the procedure in the audit of the year-end cash to determine the possibility of material fraud. And the second point was the fraud will occur if there are inadequate internal controls such as improper segregation of duty between handling cash and the recording of cash transaction in the accounting record, and lack of independently prepared monthly bank reconciliation. In standard procedure of uncovering fraud, auditors should carefully consider the nature of the deficiencies in the internal control. The type of fraud is likely to result from the deficiencies, the potential materiality of fraud, and the audit procedure that are most effective in uncovering the fraud. When auditors are specially testing the fraud, they should look at other procedure that can be useful. Other than that, a standard test of the bank reconciliation for the first point is when the auditor believes that the year-end bank reconciliation may be unintentionally misstated, it is appropriate to perform a standard test of the year-end bank reconciliation. Other than that, the extended procedure verify whether all transactions include the journal for the last month of the year were correctly included from the bank reconciliation. Lastly, using a common approach, there is 4 steps, which is start, compare, trace, and verify. Auditors start with the bank reconciliation and then compare all the remaining cancelled check and deposit slip. The auditor will trace all unclear items in November bank reconciliation and verify all the reconciliation items in the December 31. Other than that, this slide is talking about proof of cash. The first point is auditors sometimes prepare a proof of cash when the client has material internal control weakness in cash. Next point was the auditor used a proof of cash to determine whether the following are done. There are 4 points, which is all recorded cash received were deposited, all deposits in the bank were recorded in the accounting records. The third point, all recorded cash disbursement were paid by the bank, and lastly, all amount that were paid by the bank were recorded. Moreover, this slide is also talk about a proof of cash include the following reconciliation. There is 4 reconciliation tasks, which is the first one was reconcile the balance on the bank statement with the general ledger balance at the beginning of the proof of cash period. Next, reconcile cash receipt deposit per bank with receipt recorded in the cash receipt journal for a given period. Third point, reconcile electronic payment and cancel check clearing the bank with those recorded in the cash disbursement journal for a given period. And lastly, reconcile the balance on the bank statement with the general ledger balance at the end of the proof of cash period. When doing a proof of cash, the auditor is combining substantive tests of transaction and tests of detailed balance. Next, let's talk about interbank transfer schedule or test of interbank transfer. The embezzler occasionally cover a thief of cash by a practice known as hitting. This means the perpetrator of fraud, deposit, and drawing check between accounts at 2 or more banks and thereby taking advantage of the fraud. Then, fraudulent altering the figure on a check to increase the face value. To test for cheating as well for unintentional error in recording interbank transfer, auditor can list all interbank transfer made a few days before and after the balance sheet date and trace each to the accounting record for a proper recording. Last but not least, there are several things that should be audited on the interbank transfer schedule, which is the first one, The accuracy of the information on the interbank transfer schedule should be verified. Next, the interbank transfer must be recorded in both the receiving and disbursing bank. Third, the date of the recording of the disbursement and receipt for each transfer must be in the same fiscal year. Fourth, disbursement on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliation as outstanding check. Lastly, receipt on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliation as deposit in transit.
Hi, Assalamualaikum. My name is Nashaira binti Ahmad. I will continue the learning objective 5, which is we will discuss about the design and platform audit test for Impress payroll bank account. Before I explain more about audit of Impress payroll bank account, I want to recap back for the chapter 20, which is we learn about the Impress payroll bank account. So, what is Impress payroll bank account? Impress payroll bank account is the separate bank account to distribute or to pay payroll disbursement to all employees. For example, company A has two bank account which is Hondian Bank and Public Bank. This company will use Public Bank for general activities only, such as for business cash flow, for to pay loan bank, and for to pay expenses company. However, the Holland Bank account, the company will use only for pay their employee salaries. So, Impress payroll bank account is persists and relies on the company knowledge of payroll expenditure of fine sheet. So, what the company deposit or fine of the exact amount of the total net payroll to Impress bank account. So, usually take a place there directly for payroll distribution, which means the money in the account is not kept there or for any extended pay. So on the fine is paid to employees to account fine should be at or near zero. So until the next payroll due come today. Okay, next I will talk about audit of Impress payroll bank account. Test of a payroll bank reconciliation should take only a few minutes. There is an Impress payroll account and on independent reconciliation of the bank account, such as that described of the general account. So it just take a few minutes to Impress payroll from an independent reconciliation. Independent reconciliation is like it must be independent person who personal responsible about the payroll bank account. Typically, the only reconciling item are outstanding check. That means the auditor will only issue the outstanding check. What is outstanding check? Outstanding check is a payment has been recorded which has not been cleared in a bank account, and if outstanding check has not been cleared by the end of the month, it does not appear in the bank statement. In testing, the payroll bank account balance auditor must obtain the bank reconciliation, bank confirmation, and a cut of a bank statement. Okay, what is a cut of bank statement? Cut of a bank statement is a partial period bank statement and related cancel check, duplicate the deposit slip, and other document include the bank statement. The auditor use the verify the reconciling item on the client and then reconciliation. The reconciliation procedure are performed in the same manner as just described or for general cash, except that the test of the outstanding check are normally limited reasonable tests. Lastly, extended procedure are necessary if the control are inadequate or if the bank account does not reconcile with the general ledger impress a cash balance. That's all for me. I will pass the next presenter. Thank you.
My name is Shafika Oni binti Muhammad Al-Akib. So for learning objective 6, which is PT cash. PT cash is small amount of cash on hand that is used for paying small amount rather than writing a check. The purpose of PT cash fund is to offer cash to business units to cover minor expenses. The usage of PT cash money should be restricted to repayment a small cost incurred by employees. The account is verified primarily because of the potential for investment and the client expectation of an audit review even when the amount is immaterial. Next is internal control over petty cash. There are several internal control, which is first is use of an impressed fund. The use of impressed fund that is responsible for one individual. And it should be separate from all the activities. PT cash fund should not be mingled with other receipts to avoid any manipulation or fraud happen. Next is check payable to PT cash custodian. When the PT cash balance run low, check payable to PT cash custodian should be written on the general cash account for the reimbursement of PT cash. For limit amount of expenditure, PT cash should be limit on the amount of any expenditure from PT cash fund. The type of expenditure that can be made from PT cash transaction should be defined by company policy. It means that the company should list the PT cash is for what to use. Next is official approval. When a disbursement is made from PT cash, then they are required a responsible official approval on a pre-numbered PT cash form. Why they need approval? Why any document need official approval? It is because to ensure that there are no misstatement happen in the accounting, and there are to ensure that there are no fraud or manipulation happen. For audit test of impressed petty cash, the auditor need to focus on testing control over petty cash transaction rather than the ending balance in the account. There are two common procedure, which is to count the petty cash balance and carry out detailed test of one or two reimbursement transaction to determine they are supported. We are all done for the chapter 23, audit of cash balance. Thank you.